Hello everyone, welcome to Accounting 210. In this video, we will talk about Chapter 11 together. So I use this blank handout. I think you already put notes there, but let's just go through this handout together, and then we try to practice some problems together. The first thing you want to know about Chapter 11, what it's about. In Chapter 10, we said you have this actual units time actual price. You have a master budget, units time master budget, the price, and then you have flexible budget, right? You have flexible budget. So this is your actual, this is your master budget, this is your flexible budget, which is your actual units time your master budget price. And then we said the difference here called the flexible budget variance. The difference here we call volume variance, and then the main variance we call it the master budget variance. So in this chapter, we want to separate this flexible budget variance to two more variants, and then we want to look at the details regarding our cost of product, which is direct material, direct labor, and then manufacturing overhead, which has variable part and then fixed part. So make sure you know what we are doing in Chapter 11. We break down this flexible budget variance, and then we focus on direct material, direct labor, variable manufacturing overhead, and then fixed manufacturing overhead. Okay, so I'll just go through each page briefly with you. The first thing is actually we don't call it a master budget, we call it a standard budget, because instead of talking about master budget, when we say master budget, it's everything, right? But we focus on one product, which is the chips. Then if you just focus on one product, that is the standard. So you have the standard cost based on your standard you have for one case, then you have the quantity of material, price of the material. For labor, you have quantity of hour and then price of the employee hour. You have the variable manufacturing overhead, you have fixed manufacturing overhead. So total you get your standard of your each case of the chips. So the standard is kind of like the menu, kind of if you do everything perfectly, then that will be your standard cost. Okay, so we think about our direct material, direct labor, and then manufacturing overhead. But we said first, I want you to do me a favor. I said you have actual here, you have flexible budget there, and our actual is lower than our flexible budget. Remember, this is all costs. So your actual cost is lower, which means it's good, right? So we have this favorable $8,500. And direct labor, your actual number is more than your budget, flexible budget, so that will be your unfavorable variable manufacturing overhead. This is also unfavorable. So just want to make sure you know how do you put the favorable, unfavorable numbers there. We talk about this in class, so I just jump to the numbers directly. We said the way I do it is I said actual, standard. So it's AS. That's the way I put there. Different ways as long as you find a way that works for you. So we look at the material. Our focus is material. Actual, we purchased and used the same. We purchased 160,000 pounds, and our actual price is $1.4 for each. So when you put the actual number, you also put the actual number here, right? And then, but our standard, we said for 1 pound, our standard is $1.5. So we put $1.5 there. Once you put $1.5 there, you also put $1.5 on the third column because we are the same price. And what is our standard quantity of the material? We actually produced 31,000 units, and based on the standard, each unit we have to use 5 pounds of the flour. So that gives you the standard quantity of direct material. So if you do all the math, I just save my time. Let me copy copy the textbook. Sorry about that. I don't have my notes with me here. Okay, so if you do all the numbers, you should be able to find out that your actual direct material amount has to be 224,000, and then you're in the middle. I don't have a name, so that gives you 240,000, and your standard gives you 232,500. So we said the main difference of look at this, right? We said the difference of the first two columns, they have the same amount of quantity, but the only difference is you thought you will pay $1.5 for 1 pound, but you only paid $1.4. So you got a good sweet deal. So the difference, we call it the price variance, and then you have the sweet deal, so you have a 16,000 favorable. But here, from here to there, so that gives you 155,000. So your standard said you should have used 155,000 pounds of the flour, but actually you used 160,000 pounds of flour. So you didn't use the flour. You used more flour, used more pounds of flour than your standard. So that is the different quantity. They are both based on $1.5, but different quantity. So the difference of the second and third column, we call it quantity variance, and we use the more quantity. So we have 7,500 unfavorable. If you subtract, well, you can add a negative 16,000 favorable and 7,500 unfavorable. That gives us the flexible budget variance, which is 8,500 favorable. It's the same as our chapter 10. So that's all you kind of need to know when your purchase is the same as the pounds you used. When your purchase is the same as the pounds you used. But sometimes you purchase more pounds, you only use a part of the pounds. What should we do? We still, so in that situation, I just put it here. The price variance based on the quantity purchased. The quantity variance based on the quantity you used, and you cannot sum those two parts to get a flexible budget variance. What I'm telling you is that, okay, look at it here, huh? You still said A, and then AS, and then SS first. Okay, and you just do AA and AS first. So this is your price variance. We do price variance based on the material we purchased. So we purchased 105,000, right? When you put 105,000, you put 105,000 also there. Actual purchase price is $1.45. Our budgeted purchase price is $1.5. And then if you do the math, you get your price variance, which is $502,550 favorable. You thought you will be paying $1.5 per pound, but you just pay $1.45 per pound. So you have the favorable price variance. Okay, so you are done with that one. You don't even think about. Now you go ahead, do the quantity variance. When you do quantity variance, you use the quantity you use. So we do one more time of the middle part, AS. Now our units became the units we used, should be 98,000, and then we time our standard is 1.5, and our SS, right? Our SS, how do you get your standard quantity? How do you get your standard quantity? It's basically the units of your product time the direct material for each unit, right? time the dollar amount for each of the direct material. So we actually produced 20, I put it here, we actually produced 20,000 units, and then each one we said we should have used 5 pounds based on the standard, okay, based on the standard. And then each pound is $1.5. That's our standard. So if you do this, then that will give you the quantity variance is 3,000 favorable. It's 3,000 favorable. So basically, is you have two price variance and then do the quantity variance separately. Okay, and then the key part is for the standard quantity, standard pounds of your direct material. It's the units you actually produced times the standard for each unit, how many standard direct material you should use, and then times the price. Okay, so this is there actually. So those two are this one. Okay. Okay, the next page, I kind of leave it to yourself. In this video, I just want to focus on calculation more, but really make sure you read this page because it's all about interpretation. You may have some multiple choice in the exam. So how do we interpret? We have a favorable price variance. That means we save the money, right? When we purchased, we thought we have to pay 1.5. We thought we have to pay 240,000 total for the direct material, but we totally actually paid 224,000. So we saved 16,000. But does that really mean good? It depends. Maybe, as I keep saying, you sacrificed your quality to get this cheap price. Then that will not really be good for the company overall. And then for the quantity, you should have just used 232,500 pounds, but you actually used 240,000. Different reasons, maybe people wasted more, or maybe the quantity of direct material is bad, so you have to use more. So you have to go to ask the production manager to get more details. But read everything in the textbook. I know you are busy, end of semester, but still give yourself 5 minutes to read textbook, read this page. Okay. I want to show you my work here also, and then get the direct material price variance. So let's go ahead, do it quickly. So it's always AAAS and then SS. Let's see. So your total actual is 168,000. Your actual unit, your actual direct material is you used 87,500 pounds, and then your standard is 1.96 per pound, right? So when I put 1.96, I also put there, and I have to calculate my standard pounds. Is actually produced 3,500 planter. Each plant I should have used 24 pounds based on the standard. So if I do all the things there, I should get the numbers correct. I'm not going to waste your time in the video. I will post my completed work to the Blackboard. Okay, so this is the way I do it. I just put the formula here and then I found the number. Make sure you get the right number. That's all you need to worry about. Next one, sorry, I just go through quickly. I don't want you to watch the video for 1 hour. Try to control the cost. Next one is direct labor variance. So it's very similar. Now you just focus on the labor hours. You have actual, standard. So let's go ahead and put the number. So for the direct labor, it just told you the actual is you totally paid 34,875. You can do it later. You can divide it, kind of out of 15 hours, right? So you divide by 1500, you get, this is the per hour rate. Actual hour we said is here, right? 1500 times standard rate. Remember, we have to go back. Standard rate, direct labor is $22. So we time $22 for the 1500 hours. And then when you put 22, you also put 22 here. So what is our standard hours? We totally produced 31,000 units, and each one unit we said we should have used 0.5 direct labor. I'll put it there. So if you do all the math, this is already 34,875. This will give you 33,000. This will give you 34,100. Okay, and then we said the difference of this, remember, so your actual, this is actually, I'll just put it here, is 1500 times, it's already calculated 32.25. So the difference of first two columns, they all based on 1500 hours, but you thought you just paid $22, but you paid 23.25. You definitely will have an unfavorable, we call it a direct labor rate variance, and then you pay more than your standard. Totally you paid $1,875. And then for here is, so that gives me 55. Okay, so for this is you based on $22 standard rate, but you thought you should have used 1,550 hours, but you actually used 1,500. You used 50 hours less, so you are more efficient. So that is called direct labor efficiency variance, and we totally saved $1,000 because we are more efficient. Make sure you read one more time, you read the interpretation here. Make sure you really read why we paid a higher price for the rate. You know, maybe we, human resource said, hey, we cannot get people at $22, or many reasons why we have more efficiency. Maybe because we got high quality employee, we pay them a higher price, but they are, you know, they are experienced, they are more efficiency. So we saved 50 hours. Actually, we saved 50 hours. So our total will be our direct labor flexible budget variance gives us $775 unfavorable. Hey, this doesn't look like 1,000. Hold on, my fault. Sorry about that. Okay. $775 unfavorable. Perfect. I'm correct. Okay. Okay then. Oh, I don't know why I put this sentence here. I don't think you need to have this sentence here. I think I rearranged my handout. So that summary, oh, that summary should be here. Okay. Okay. So next one is just an example. I show you my work. Later I posted to the Blackboard, but I just put the things here. We said your actual, I look at actual hour is 310, and then 24. When I put 310, I put 310 here. My standard is should be 17. And then when I put 17 there, I put 17 here. And then my standard direct hour should be totally made oil change 1,600. So that is my output units time my, you know, for one oil change based on standard is 18 minutes, 0.3 hour. So that will give me all the numbers. I just need to put all the numbers there. And then you get all the variance. As I keep saying, I will post this to the Blackboard. Don't want to waste too much time here. Next one, talking about manufacturing overhead. Oh, not there. advantage and the disadvantage of the standard budget. I also leave this to yourself. Make sure you read textbook, read the handout. Just get a general idea so you can get the right answer in the multiple choice. Sorry, finally talking about manufacturing overhead. When we do manufacturing overhead, for the variable, it will be very similar because it's a variable. So you also have this actual and then in the middle, and then also your master budget. So look at this example. Look at this example. Kind of getting my answer there. Manufacturing overhead is similar with the labor, but this one you allocate your manufacturing based on machine hour. So we focus on machine hour. Okay, we focus on machine hour. And then your actual manufacturing overhead is already told you that 85,200. I'll just put 85,200. Actual machine hour is 3,000 machine hour, and then our allocation rate is 25. So when you put 25 there, you put 25 here, right? You put 25 here also. It's also the same as our standard, that is $25 per machine hour. And then what is our standard machine hour? Then this is the rate. What is our standard machine hour? We totally produced 31,000 case. For one case, we said we should have used 0.1 machine hour, right? So that will give you the numbers here. Okay. So let's do all the number. That one just 85,200. That one gives me 75,000. This gives me 77,500. So I'll just do the variance, and then you read the explanation by yourself. Still, difference of the first two columns. They are also the rate, but it's not the direct labor rate. You have to make sure it's variable manufacturing overhead rate variance. You thought every machine hour should allocate $25, but actually it costs $28.4. So we have the unfavorable. You don't even need to look at the number. You know it has to be unfavorable. The second column, the third column is also efficiency, but we don't call it just there. We have to see variable manufacturing overhead efficiency variance, right? Efficiency variance. You thought you will use 3.1 thousand machine hours, but you actually only use 3,000, so you are more efficient than you thought. So you definitely will have a favorable here, which is 2,500 favorable. As I say, manufacturing overhead is hard to interpret. It's hard to interpret, so I don't really require you to know much about interpretation, but just get a general idea, just help you to understand the calculation. But for direct material, direct labor, you have to know how to interpret those things. Okay, want to go through this one also with you quickly. I still put AAAS and then SS. Let's see, actual machine hour is 1170. When I put 1170 there, I put 1170 there. Actual rate was 22, so I just put 22 as actual. My standard budget is 24. When I put 24 there, I put 24 here also. I produced 4,000 table, and then each table I should allocate 0.3 machine hours. So I put all the numbers there. One more time, I will show you my final results in a handout. Okay, so last thing is about our fixed manufacturing overhead. It's a little bit different because it's fixed, so we cannot really do that. But I think in the classroom, we just found out your left side is still actual, your right side is still the standard. but in the middle, it became the budget. So it is actual, budget, and then standard. Basically, it's that. So your actual for this question is your actual fixed manufacturing overhead $31,025. Your budget is $30,000, and then your standard is always your actual made 31,000 units. And each unit for the fixed manufacturing overhead, you allocate 0.1 machine hour. Each one is $9. So you time 0.1, you time $9. And this doesn't need to have any calculation. So you got your last one is 27,900. Okay. So first, make sure how do you do that? How do you name those things? First column, second column is all about your budget, actual and your budget. So the difference we call it fixed manufacturing overhead budget variance. You budgeted as 31,025. Sorry, you budgeted 30,000. But your actual is 31,025, so your actual is more than your budget. So you have $1,025 unfavorable, you cost more than your budget. And then, okay, so here is the thing you have to memorize or understand. You got this variance, second column and third column. You got this one called fixed manufacturing overhead, volume variance. We first know the number is 2,100 unfavorable. What is that test about? What does this tell us about? Volume variance. Okay, volume variance. Just want to give you an idea. When you did your predetermined rate, we said it's $9, which is your total estimated this divided the estimated cost driver, you get your predetermined allocation rate. Remember that's in, I don't know which chapter 3, chapter 4 around there. When you allocated that, when you did your predetermined rate, you actually, this question cannot tell you, but if you read textbook, you can find it. When you did that, you thought, you estimated that the month you will produce around 33,000 units. That's when you did your estimation, when you do your predetermined rate. You thought you would produce 33,000, but your volume didn't reach at your expectation. You only produced 31,000 units. You thought you will reach the volume of 33,000, you only did 31,000, so we have unfavorable volume variance. So make sure you memorize this sentence. When our production volume, which is 31,000, lower than expectation, 33,000, we will have, say, unfavorable volume variance. Then if you produce more, let's say you produce 35,000, your expectation is only 33,000, then you will see favorable fixed manufacturing overhead volume variance, which is the first, which is here, right? Make sure you know that. That is all the interpretation I want you to do for the fixed manufacturing overhead. Okay. Last one. I'm not going to do my accounting lab. I think I just posted the solution directly to you. You can, I know you are smart. You can do it by yourself. Okay, so I put the actual, I put the budget, I put the standard here. I don't have a solution, so let me look at the question quickly. Require 4 hour times labor for the current calculate. Predetermined rate is 26. Company budget fixed. Okay, will be, so this budget just told 202,000, right? Produced and incurred. So actual told you 198,400. So we just need to do the standard is, okay, so our standard is we produced 2,000 horses each one require 4 hours of machine hour, and then each machine hour we allocate $26. Okay, I think that's all I need to do for now. As I say, I do all the numbers and then I post this to the Blackboard. Okay, sorry about that. I think rushed you very much in the video also, as I always do in class. Chapter 11, many things to practice. Make sure you give yourself enough time to review and do all the work. And always let me know if you have any question. Thank you.